Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. Today, we are strapping in for a major market reality check. For the last couple of years, really, the investing world has been obsessed with just one thing: explosive growth, right? Especially growth powered by the AI revolution. But the source materials we've gathered show a massive, maybe even brutal pivot is underway. The easy money looks like it's gone. And the market's focus has shifted hard from just cheering revenue increases to demanding actual tangible profitability and, managing these brand new global risks.
That's absolutely right. That whole growth at all costs mentality from the last cycle, it's over. Done. The market seems to have matured almost overnight. It's now far more demanding when it comes to capital efficiency. So over the next few minutes, we're going to give you the insider's view on this new reality. We'll unpack three major economic stories that, yeah, they might seem complex, but they're absolutely crucial for any investor right now. Number one, the AI profitability shock that just, well, exposed some vulnerabilities in the cloud sector. Two, the dramatic shift in what keeps global CEOs up at night. It's changed a lot. And three, how geopolitics has fundamentally turned basic agriculture into, believe it or not, a strategic weapon. And we promise we'll use some simple, actionable insights, maybe some analogies, to make these aha moments stick.
Okay, let's dive into this. We should probably start where all the money's been flowing. AI. You're saying the party might be over for companies that can't actually show a profit. This whole first segment seems to hinge on what the sources are calling the Oracle shock. Sounds dramatic. It revealed some pretty deep cracks in the AI infrastructure business model.
Oh, it was a massive wake-up call, yeah. And it really boils down to the basic economics of the cloud. The initial report, which came from the information, it really rocked the market. It claimed that the cloud companies offering AI infrastructure, renting out those super expensive NVIDIA servers, were operating on just razor-thin margins, maybe as low as 16% on that specific hardware rental piece.
16%. Wow.
Yeah.
That sounds like a huge problem, especially when you've poured billions into building data centers. So the market was basically looking at this and saying, hold on, you built this amazing AI highway, but you aren't charging enough tolls to even cover the construction. So what did Oracle CEO Larry Ellison say? How did he defend against this margin disaster story?
Well, his defense wasn't just a simple denial. It was actually quite a brilliant reframing of the whole AI business model.
Yeah.
He argued that, yeah, okay, maybe that low 16% margin represents the simple hardware rental margin just renting the physical box. But, he stressed, the vast majority of their high-value AI customers aren't just renting a server. No, they are buying a bundled sale.
Okay, bundled sale.
Yeah.
What does that actually include that boosts the margin so much?
Right. So it includes the hardware, yes, but crucially, it's bundled with their proprietary high-margin software services, things like their autonomous database or their Fusion ERP cloud applications. So when you factor in the value and the margin of that entire software bundle, which, let's face it, the customer needs to make the AI infrastructure actually do something useful, Ellison claims the real margin is 50% or maybe significantly higher.
Ah, okay. So here's the analogy we need to kind of cement that idea for you, the listener. It's the classic razor and blades model, isn't it? A company like Oracle might sell you the AI infrastructure, the hardware, the razor, really cheap, maybe even at a loss, who knows? But the real profit, that juicy 50% plus margin, comes from the constantly purchased high-margin ink cartridges, which, in this case, are Oracle's proprietary software and database services you need to run your business on their cloud. Makes sense.
Exactly. And that distinction, that's the crucial insight here. It defines what we could call the second act of the AI rally. For the past 2 years, we judged AI stocks mostly on just one question. How high is your revenue growth? Simple. This Oracle shock forces investors, forces you to ask that critical second question. Okay, fine, but how much profit did you actually keep? And importantly, where did that profit come from?
But hang on, if the market is just demanding profit, couldn't we just look at, simple net income? Why focus on a specific, maybe more complicated metric now? What's better for filtering out this unprofitable growth?
That's a really key distinction because we aren't just looking for any profit, we're looking for efficiency. How efficiently are they deploying capital? That's why you, the investor, must now focus on profitability metrics, like primarily return on invested capital, or ROIC. ROIC is king here because it filters out growth that's just fueled by debt or isn't sustainable. Companies that can give you clear, verifiable answers to what's the margin on this AI contract, and how fast is the payback period on that multi-billion-dollar data center investment. Those are going to be the new winners. This is how you spot high-quality profit, not just, temporary revenue bumps.
Right. And this whole hunt for profitability, It really highlights this coveted distribution of profits happening right now, doesn't it? The sources seem to confirm NVIDIA is still holding most of the margin. They're the pick and shovel winner, the ones selling the tools for the gold rush. But the cloud providers, they must be getting tired of basically subsidizing NVIDIA's gold rush.
They absolutely are. I mean, the scarcity of margin, it creates enormous competitive pressure downstream. So future possibility one, you'll see cloud companies aggressively looking for alternatives. Think AMD, or even developing their own proprietary chips. Anything to put heavy price pressure back onto NVIDIA. Future possibility two is what Oracle's trying to prove works. The real fight moves up the stack to that high-margin proprietary AI software and platforms that run on the infrastructure. That's where the lasting economic value is now hiding.
Okay, so if we're looking at the AI world today, how should you triage your investments now that profitability is suddenly the name of the game?
Yeah, we can sort of break them down into three groups for you. Makes it simpler. Group one, the sure winners. These are the core, kind of irreplaceable tech companies. NVIDIA is the prime example. They hold high margins on essential components that pretty much everyone needs. Group two, the battleground. This is where you find the big cloud providers Oracle, Microsoft, Amazon. Their success now hinges entirely on, one, superior cost management, and two, their ability to successfully pivot to selling those high-margin software bundles on top of their infrastructure, just like Ellison described.
And group three. I'm guessing these are the ones to be careful with.
The most dangerous, yeah. These are the companies burning just massive amounts of cash on developing AI models without a clear, defined path to actually making money. They were cheered on in that growth at all costs era we just left. But if the market is demanding profitability now, well, these firms face the most immediate and probably painful reckoning. Their runway is getting shorter, fast.
That's actually a perfect transition. Speaking of painful reckonings, let's shift from the AI balance sheet to the global boardroom. Our sources are showing that what CEOs are worrying about has changed dramatically in just the last year. It's moved way beyond typical business worries like, labor costs or something.
Yeah, what's really fascinating here is the swap in the number one spot. It's quite telling. For the first time, the top short-term risk for CEOs isn't supply chain issues anymore. You remember how that dominated everything during the pandemic years. Well, that crown has now been taken by geopolitical instability and political risk. This covers everything from the threat of trade wars flaring up again, instability in Europe, or even domestic political risks like, say, potential U.S. government shutdowns, supply chain resilience. That's now seen as just a result of managing this bigger geopolitical risk successfully.
Wow. So if global CEOs are genuinely afraid of it, then you, the investor, really need to actively guard against it. What's the investor insight here for hedging against this new kind of geopolitical volatility?
Yeah, a geopolitical hedge really needs to be central to your portfolio strategy now. It can't be an afterthought. That means looking at traditional safe havens like gold, or maybe investing more heavily in U.S. domestic-focused companies that are relatively insulated from global trade spats. Another option is assets based in stable, non-conflict regions. Think Switzerland, places like that. The key is diversification away from politically charged supply lines.
Okay, risk number two for CEOs. This one confirms that Oracle shock wasn't isolated. It's the AI ROI disappointment. Sounds familiar. This links directly back to that profitability problem we were just talking about.
It does, and this is maybe the most sobering statistic coming out of the boardroom right now. The hype drove massive spending, right? Get this. 95% of U.S. CEOs say they have invested in generative AI. 95%. But the profits, they just haven't materialized yet for most. Only about a quarter, just 25% are actually seeing the return on investment, the ROI that they expected. So they spent the money, but the efficiency gains or the new revenue streams, still largely theoretical for many.
So if the first act of the AI investment rally was all about adoption and just spending the money, the market is now demanding AI performance in Act 2. What does that mean for your investment strategy? How do you play this?
Correct. Investors should probably ignore the big, splashy language models for a moment. Instead, look for B2B AI software and automation tools that can prove demonstrably that they generate cost savings or new profits. Look for companies selling software that actually cuts, say, 30% of back-office costs, not just companies promising some revolutionary chatbot sometime down the road. Performance and efficiency now trump novelty.
Okay, let's jump from a current risk to a future risk that seems to have suddenly become a near-term threat, quantum computing.
Yeah, what's fascinating about quantum is how quickly it's moved from, abstract science fiction and movies to an acknowledged near-term corporate threat. People are taking it seriously now. See, quantum computers, when they're fully realized and we're getting closer, pose an almost existential threat. Why? Because they'll be able to neutralize the current standard of public key encryption. That's the tech that secures almost everything we do online. Banking, communications, military secrets, everything.
And the data shows a pretty scary gap in preparedness among corporate leaders on this one.
Exactly. A full 60% of CEOs admit they are not prepared for the threat of quantum computers, basically neutralizing current encryption standards like RSA. That realization, that dawning horror maybe, is creating a massive new growth theme. It's driven by, frankly, sheer corporate panic.
Okay, panic often leads directly to opportunity for investors.
Yeah.
What is that new growth theme?
Well, this signals the imminent birth of a whole new industry, post-quantum cryptography, or PQC. We're looking at major long-term themes centered around software firms developing the next generation quantum-resistant encryption algorithms. And also cybersecurity consultants who specialize specifically in helping large companies achieve quantum readiness. You should absolutely expect security spending to spike again, but this time driven by this unique existential threat.
And finally, just a quick note on M&A. You mentioned the type of deal CEOs are looking for has shifted, partly because of the current antitrust environment under the Trump administration.
Yeah, the administration's current stance on antitrust is actively discouraging those massive mergers, the mega deals we saw maybe a few years ago. So consequently, CEOs are pivoting. They're focusing on smaller, more targeted, tuck-in acquisitions. What are they prioritizing? Securing niche AI technology and, just as importantly, critical human talent in AI. This makes small, innovator tech firms, the ones with specialized knowledge, suddenly highly attractive acquisition targets for cash-rich big tech companies. They need to shore up their AI talent and tech without drawing too much regulatory heat.
Okay, we've covered cloud margins, boardroom anxieties. Yeah, let's finish by looking at how this whole trade war situation is playing out in the most basic commodity there is, food. You call this the weaponization of agriculture. That sounds serious. And it's a stunning illustration of geopolitical risk in action.
It truly is. The sources we looked at show China is, well, no longer viewing the U.S. as a reliable, stable source for its agricultural goods. This isn't just a temporary spat. It looks like a cold, calculated, strategic retreat from being overly dependent on American farm products.
And the numbers you found are shocking. U.S. soybean exports to China plummeted. By how much?
By a massive 78% just from January to August of this year, 2025. 78%. They essentially just stopped buying from the U.S.
Why? Why make such a huge structural shift like that?
This is all part of China's broader, comprehensive food security strategy. They are actively working to eliminate what they see as a potential point of political leverage that the U.S. might try to use against them in a future trade conflict. So to eliminate that vulnerability, they're actively diversifying their supply lines away from the U.S. They're turning to countries that are perceived as politically less hostile, primarily Brazil and Argentina. This isn't just a temporary trade dispute. The data suggests this is a long-term structural shift in global food sourcing patterns.
And this leads us straight into what you call the U.S. farm subsidy trap, where the overall headline numbers might look okay, but the reality for the actual farmer is pretty bleak. The USDA is predicting a massive 40% rise in farm net income. How on earth do we reconcile that rosy prediction with the reality of exports collapsing?
Yeah, the reality is that U.S. grain farming especially is currently on a kind of government-funded respirator. That huge 40% income jump, it's a false signal. It's driven almost entirely by massive government subsidies, things like the American Relief Act. These subsidies account for roughly 22% of total farm income right now. But the actual grain farmers, the ones most hurt by China, basically walking away from soybeans, they're actually seeing their cash income fall by nearly 5%. The sector is being propped up entirely by government intervention.
Wait, so let me get this straight. The government is essentially raising money by levying tariffs on goods, which makes it harder for farmers to export. And then they're using that exact same money to pay those farmers because they lost money from not being able to export. That sounds like a bizarre, completely self-defeating economic loop.
Bizarre, yes. But strategically consistent, maybe from their perspective. It is a self-perpetuating cycle of, arguably, policy failure. The source material details that the recent $10 billion relief package announced by the administration is funded largely by the very tariffs that caused the farm crisis in the first place. The unintended consequence here is that this massive subsidy program distorts global pricing. It prevents U.S. farmers from naturally adjusting to the new, lower demand reality from China, and it keeps global prices artificially low, which makes it harder for unsubsidized farmers everywhere else in the world to compete fairly.
Okay, so for you, the investor, navigating this new, highly politicized agriculture market,
Hmm.
what are the actionable insights? What do you do?
Right. First, you have to accept that volatility is the new normal. Agricultural commodity prices are now driven as much by the ups and downs of U.S.-China relations as they are by weather patterns. That means you need to factor a geopolitical risk premium into any ag investment. Second, look south. Look for the structural growth opportunity in South America. Brazil and Argentina are the clear winners here, gaining market share probably permanently. This points to investment opportunities in their farming companies, related real estate investment trusts, REITs, and importantly, the port and logistics firms that are needed to handle these massive infrastructure expansions to get those goods to market.
And finally, within this high-risk sector, is there a safer path?
Well, the pain and the subsidy trap actually force U.S. farmers to maximize efficiency just to survive. This desperation creates huge, resilient demand for agritech. That's probably the safest haven. So you should look at precision farming companies, the software and hardware that optimize seed and fertilizer use. Look at biotech firms developing drought-resistant crops. Look at farm management software. These companies offer a safer way to invest because their demand is driven by that fundamental need for efficiency and cost cutting, almost regardless of where volatile commodity prices go next. So we've covered a lot of ground today, but you can see the narrative arc, right? It's pretty clear. We've seen the big pivot from that emotional growth at all costs phase to the rigorous demand for profitability now, especially in AI. We tracked how CEO risk has shifted dramatically from logistical supply chains to these intractable global political issues. And we finished by looking at the strategic weaponization of basic commodities like soybeans. The consistent theme through all of this, it's the absolute need now to apply precise, cold analytical metrics like ROIC and to always factor political risk into your valuations. Hype is out, analysis is in.
That really is the essential takeaway, isn't it? Just think about how quickly geopolitical uncertainty can ripple through sectors that seem totally unrelated, from cloud computing margins way out in Silicon Valley right down to the soybean fields in Iowa. So the next provocative question for you, the listener, to consider is this. What other core industries right now are highly vulnerable to these kinds of policy paradoxes or unexpected political pressures that maybe we haven't even considered yet? Because that's likely where the next big risk, maybe the next highly profitable opportunity lies hidden.
That's an excellent point to end on.
Don't forget to subscribe and hit that like button.